one should not pretend that credit is the same as equity. Equity is lower in the capital structure, credit is higher, but it is not observable, it's not consistent, and it's not liquid. You need to accept these facts.
Welcome everyone to a new episode of The Blunt Dollar. Today's guest is Orlando James, the founding partner and chief investment officer at Farrier Asset Management, a specialist credit hedge fund focused on extracting alpha from overlooked corners of the market.
People use financial models that are simply estimate. There is no true efficiency. There are more efficient markets and there are less efficient markets. Expansion and contraction that happens really every minute. That is the opportunity for us. We're saying, where have the markets dislocated? Where are the best risk-adjusted return opportunities? And hopefully, where can we find asymmetric payoff profiles?
This is The Blunt Dollar with Ignacio Ramirez. Quick disclaimer, the views and opinions expressed in this podcast are those of the speakers and do not constitute financial investment or legal advice. This content is for informational and educational purposes only and should not be relied upon as a substitute for professional advice. Always do your own research and consult a qualified advisor before making any financial decisions. All investments involve risk, including the potential loss of capital. And now, let's get started with the episode. Welcome everyone to a new episode of The Blunt Dollar. Today's guest is Orlando James, the founding partner and chief investment officer at Fairwater Asset Management, a specialist credit hedge fund focused on extracting alpha from overlooked corners of the market. Orlando's career spans from fixed income sales at Deutsche Bank to leading structured credit at Hermes to running his own fund at Fairwater Capital before launching Farrier. What makes Orlando stand out, in my opinion, isn't just his experience across the capital structure, it's the way he combines deep credit intuition with a relentless focus on data. At Farrier, he built a team of STEM PhDs and coders, all working to clean dirty credit data, model pricing inefficiencies, and run systematic strategies that aim to deliver repeatable alpha. We'll talk about repeatable alpha a lot today. In this conversation, we get into why convertibles, a tiny slice of the market often ignored by big multi-strats, might be one of the best risk-adjusted opportunities out there. We'll also talk about the evolution of credit markets, the psychology of being an emerging hedge fund manager, and why Orlando believes beauty, creativity, and rigorous data science all belong in the same sentence. Orlando, it's an absolute pleasure to have you on the show. Welcome to The Blunt Dollar.
Ignacio, it's absolutely fabulous to be here. Thanks for having me.
So, I always like to start my interviews with the same question. Can you tell us a bit about what is it that you're doing exactly in your day-to-day at Farrier? How does the typical Orlando day look like?
So 3 months ago, I launched my first hedge fund strategy. So we are an emerging manager. I come from a very different background. I didn't work at one of the multi-strategy funds. As you said, my last institutional job was as head of structured credit. So in the past decade, I've been a full capital structure investor. And I think I've peeled the onion on both credit and derivatives and capital structure. I've been involved in some complex situations, and I felt that I had developed a strategy and idea that could deliver this idea of repeatable alpha. So while I'm a fundamental credit and a fundamental investor, three years ago, we started developing a strategy focused on convertible bonds and what people know as convertible arbitrage. And one of the ways that we do that differently is that we hire PhDs from STEM disciplines and we write codes to aggregate data. We then clean the data so that we can make credit data continuous and clean so that we can study it as frequently as possible. And then we study the relationships, particularly between equity and credit. Our thesis is that equity and credit markets are dislocated. So even though we start with big fundamental themes, what we don't want to do is rely on our intuition as traders. So we hire, we train people from these STEM disciplines. We've built our own data lake, and we built a database that tells us where to look for alpha, this repeatable alpha that's become a little bit of a joke amongst my friends and family, because really what we're trying to find is, can we identify trades that make money frequently,
Mm-hmm.
and can we avoid trades that lose money? So we take fundamental ideas, we gather data, we study the relationship between equity and credit, and we try and find trades that have high risk adjusted returns. So that is my day.
So, just for those of you that don't know what STEM disciplines are, it's science, technology, engineering, and mathematics. So, pretty technical people. Imagine Orlando's office full of data geeks, crunching numbers and coding. That's how I imagine it. Whilst having a lot of fun, of course. Um, so, you've talked about repeatable alpha, what it is. Where do you think true repeatable alpha is coming from today?
So the way that I think about it is, you have a very small number of geniuses, the truly brilliant traders, and then you have people that have an edge. And that edge can be from a wide range of different things, and that it varies across asset classes. There's more edge in certain asset classes. So in large cap equities, there's a lot less. In small cap equities, in emerging markets, and it's the same in credit. There's very little edge in investment grade. We think there's the most alpha in convertible bonds. High yield, it ranges. Distressed credit, there is a lot of alpha, but it also comes with a lot of volatility.
Mhm.
And credit as an asset class uh, has a range of characteristics, both strong and weak, and you need to embrace those. So if we accept there are these a very small number of geniuses who have been able to build incredible businesses, been able to scale what they do. Sometimes it's from a great idea and a great individual. Sometimes it's like Millennium, where they have built a machine that is exceptional at delivering uh, high alpha and high risk adjusted returns at great scale. So there's a few of those people, and it's really not many. Then there's the people who have found an edge, and you have to maintain edge. And then, unfortunately, there is the wider percentage of hedge funds that have failed to deliver a Sharpe ratio above one, which is kind of the standard for me. If you're below one, then then it's pretty unclear what's your reason for being. But nonetheless, it's less than 20% of funds that have a
Mhm.
Sharpe ratio above one. So it's clear that the investors need a wide range of things from their managers. And so it's not as simple as saying, if you don't achieve this risk adjusted returns. But I suppose at this stage of my career and this stage of my life, I've invested a huge amount of my time and my effort, my own personal capital. My family have invested. We have one institutional investor, um, and we've decided to do something that is pretty close to unique. We've launched a hedge fund without having a track record that was established at a multi-strat, or having been the number two PM behind somebody else, and then spinning that out with seed capital.
Mhm. I have a question in your quest on for repeatable alpha, and by the way, congratulations on launching the fund.
Thank
I'm
you.
very excited to see what you guys are going to do over the upcoming years. But yeah, coming back to the search for repeatable alpha. So your thesis is that credit and equity markets are often dislocated. Why do you focus on this relationship between credit and equity?
So equity is a dynamic asset class. Every second that we have a visible, observable, and tradable price. It may not always be liquid, um, but we can observe the liquidity, and we can see the way that the share price responds to idiosyncratic or macro or market structure
Hmm.
changes. But in credit, that is not the case. And not only is it not the case, but things have actually deteriorated since the financial crisis. So when we used to have a full suite of credit instruments ranging from loans to bonds to credit default swaps to indices. Now we have the proliferation of ETFs, which does solve some problems, but it creates other issues with liquidity caught in certain areas. So at every moment, the equity is moving and the credit in reality is moving, but it's not observable. And therefore, there is a lot of art in working out what is the difference between an on-the-run and an off-the-run bond, so the liquid and the illiquid bonds, and between different points in the curve. And so, we're going through US earnings season at the moment, and there has been a number of stocks that have traded up 20 and 30, I think even 50% in one day. And then you need to adjust each of the bonds and the credit default swaps and the convertible bonds in the capital structure. And then you need to do so dynamically. And yet, over the last 17 years, the market has become less observable, often less liquid, less transparent. And so those relationships that expand and contract at all times, we have found them to be incredibly inefficient. And people use financial models that are simply estimates. Even Eugene Farmer talks about what he does and says, ultimately, what we have got is just an estimate. There is no true efficiency. There are more efficient markets and there are less efficient markets. Equity is more efficient than credit. Investment grade is more efficient than high yield. US is more efficient than Europe, that is more efficient than Asia. So it's this expansion and contraction that happens really every minute that is the opportunity for us. And also there's also a very different mentality when analyzing a company from an equity and credit perspective. Credit is bound by zero, and saying the credit spread can only go to zero. In the majority of cases, you're looking for an asset that repays at par at 100, where when things go negatively, you can go to zero. But in equity, there is no upper bound. Equities can go to up to a relatively unlimited number. So the dynamics that affect these markets are very different. We observe the dislocations. We use data to capture those dislocations so that we're not just focused on an Excel spreadsheet, and we're certainly not basing on our intuition. We're saying, where have the markets dislocated? Where are the best risk-adjusted return opportunities, and hopefully where can we find asymmetric payoff profiles?
I'm curious to hear, because you alluded to liquidity several occasions. How does a hedge fund manager like you think about the concept of liquidity? Because I'm a fixed income advisor, and I have the feeling that a lot of times my clients in wealth management are not really aware of liquidity risk, or they choose not to put too much weight on it. But reality is that liquidity is so important, and it's one of those things that no one talks about until it becomes literally the only thing that everyone talks about, particularly for fixed income, which, as you said, is more of an illiquid market, is traded over the counter and so on. How do you think about liquidity in your investment process?
Well, I think it's important to be honest about the fact that uh, the finance industry is about selling certain stories, and saying that everything is about risk and return, and that um, a lot of people do not focus on the weaknesses in a security, and to me, the weaknesses are a lot like your mistakes. You learn from your mistakes, and you grow and you evolve. And one should not pretend that credit is the same as equity. It just, obviously, equity is lower in the capital structure, credit is higher, it has a higher margin of safety, but it is not observable, it's not consistent, and it's not liquid. And you need to think about both liquidity trees of going, so, with size, liquidity on the whole goes down, and with volatility, liquidity also goes down. But, there can be variations of this theme. So you need to accept these facts, and it's something actually we've had to focus on when we launched our hedge fund, because we are very data focused and we know exactly how many times and what's the volume of trades of every convertible bond in the US. And we were thinking, if our minimum size is $1 million
Hmm.
for a bond, then we should be able to trade pretty much all 500 bonds. But that's not the case. The reality is that even for 1 million bonds, there are really 175 to 200 bonds out of the 500 in the index that you can trade every day. Now, there is a price for every bond, but you may not be happy about that price. And what we see is when there is volatility, suddenly the bid offer becomes that much wider. Banks, because these are trading OTC, do not stand up to their bids and offers. So what you think is an observable and as a tradable price is
Hmm.
no longer the case. And I think if you're somebody who's traded credit through the financial crisis, and pretty much everything was this way, of you had to liquidity test everything and assume that with complexity, um, that and with size, liquidity became that much lower. And we even see this in US Treasury markets. This year, there was a big story about the blowout in the basis trade between the futures and the US Treasury bonds. So, this is the nature of markets. Liquidity has changed a lot in the last 17 years, and
Hmm.
it's vital that you're aware of it.
Yeah, thank you so much for that explanation. And yeah, I fully agree um, with everything you said. And for our listeners, really, like, we cannot emphasize enough how hard it is to trade fixed income during periods of volatility. And the tricky thing is that um, it's also very hard to measure liquidity, to be honest. Like, a bunch of people have tried different things. I'm a Bloomberg user. They have different liquidity indicators. You can see the number of bids you have on your screen and things like that. But really, it's only once you are about to place the order sometimes that you really know if you're going to be able to buy or sell at a certain level. So it's a very, very tricky concept.
Well, I think it's the combination, and this is how we are as a group, of combining the fundamental and the experience with quantitative. It's, we've interviewed people from some of the very big firms, and what they complain about is the silos of that. They just say, okay, you are a data scientist, you're a quantitative analyst, we're going to give you a data set and go and find alpha, where that's the antithesis of what we do. We hire people straight out of their PhD programs, and then we spend time with them working on concepts. We say, this is what we've observed. Please go and collect this data. It needs to be cleaned in this way, that a price from the leading investment bank is very different from a price from a regional European or Asian bank. So, that of living through that, and it's the same with even things like credit default swaps. It's obviously in options, we can look at what is the open interest of every different strike. So there are solutions. The problem is we get a lot of equity people trying to apply equity-like solutions to credit, which often doesn't work. And credit people don't like to focus on the data. It's real for a lot of them. They think of it as very boring work, that they'd go, I'd much rather analyze macro or analyze companies or analyze maybe the market structure and different technicals. But they
Mhm.
don't think, wow, it's exciting to actually collect the data minute by minute. So rather than think relying on our intuition and our kind of our first system of our brain, that we can actually go into the second system of our brain and be much slower and much more thoughtful, and think about, okay, the data is telling us something that is either consistent or inconsistent with our intuition.
And you guys at Farrier, basically your strategy, if I understand well, is convertible arbitrage, which is this sort of niche that blends credit, equity, and optionality. I have two questions. One, can you explain to our listeners what a convertible bond is? And two, why did you choose to focus on convertible bonds and arbitrage? Hey there, quick favor to ask. If you enjoy the blunt dollar, the unfiltered takes, the stories, and the laughs, the easiest way to support the show is by tapping that subscribe button right now while you're listening. And here's my promise. If you do, I'll keep bringing you honest conversations, fresh perspectives, and the kind of finance talk that's engaging, insightful, and worth your time. Thanks so much for being here, and let's keep these great finance conversations going.
So a convertible bond is a hybrid security. It is a corporate bond that has a call option attached to it with some very complex features. So every prospectus needs to be analysed, and every bond needs to be constructed differently so that you understand all of their features. The bonds still trade over the counter, so you still need to trade over a Bloomberg terminal and with the largest investment banks. It's a very difficult security to buy on a retail platform or even even through a private bank. But it has the upside, part of the upside of an equity, and it has the protection of a senior unsecured bond. So being pari passu most of the time with the senior unsecured bonds of that company. However, the majority of convertible bonds are unrated, so it requires a lot more work to value the credit spread and to assess the probability of default. The convertible bond market is much bigger in the US. It's shrunk a lot, and it's had real challenges in Europe. But you do get a lot of companies that that have been through some challenging periods, or that that the market is not wholehearted in their support. So it is a hybrid form of capital. So we've now had a huge number of crypto companies issuing into the US convertible market. We have a lot of technology companies. We have AI companies. We have pharmaceutical companies. We have EV companies. Tesla was an issuer. More recently, we've had EV companies in the US and in China. So you get really interesting companies at critical junctures in their development, and they're accessing this product that has this security that has the benefits of the upside with the protection of a bond-like features. So in the event of default, there is a higher probability of a recovery. Convertible arbitrage is buying convertible bonds and using different methods to calculate the delta, the sensitivity of the convertible bond to the underlying equity price, and then shorting a certain amount of stock versus that convertible bond. So you buy the bond, you calculate a delta, and then you short stock versus that bond, and you hold that for a period, and you seek a certain payoff profile. And then there's a wide range of different sub strategies within convertible arbitrage, but that's the core idea.
And within convertible arbitrage, are you focusing on a particular strategy, on one of those, or you do a bit of everything?
So we've done things in a very different way. We've started collecting data, and we develop individual strategies. We test them, and then we implement them in the market. So we've started with one strategy that is quite different to all of our peer group, which is around mean reversion. So we use our own data to calculate fair value. We calculate a delta. We calculate when the bond becomes cheap to our fair value. We put it on, we hedge it, and then we exit the trade when it reaches our target. That surprises quite a lot of people in the market. It refutes a range of the arguments that in order to cross two bid offer spreads, or because of the cost of trading, that you could actually make money by exiting a trade so quickly. But what we've seen, what was part of our thesis before we started trading, and what we've certainly seen once we're trading, is that the market has actually become less dynamic. The US market, which is larger and more efficient, actually uses some um, pretty basic models on some of these concepts. So when the stock moves by a significant amount, the market makers and the street may not move their deltas particularly quickly, where our system allows us to reprice the delta for every cent that the stock moves.
So, hearing you, I feel like data is a very close topic to your heart. And I know a lot of hedge funds, they decide to invest millions and millions into building their own data infrastructure from scratch. Um, Tell us a bit about how you've done things at Farrier. Why did you decide to build a data lake internally instead of relying on external vendors? And yeah, how does a hedge fund manager like you think about data specifically for convertible bonds?
So I suppose going back to some of the points that I made before, you know, I think you're either a genius or you have edge, or you're going to be part of the pack. So, I knew I wasn't a genius. I saw many of the flaws in credit. I had traded credit default swaps, and I'd also traded CDOs and even more complex products like CDO squareds and CPPIs prior to the financial crisis. So I'd worked with complex models. I came to realize that even though the market doesn't sell it this way, they are just estimates. And they are also estimates that are based on highly subjective inputs. And the subjectivity of those inputs becomes that much higher when you have volatility and when it becomes difficult to observe what the fair market spread is or what a tradable spread is. So even going back to 2004, when we were trading a lot of credit default swaps, we started to aggregate and clean data and say, rather than looking at things on an end of day basis, we can do so dynamically, and we also can do it independently. We're not buying the data from a third party. It's our own data, so that if we say we want to exclude certain data points because we don't think they're reliable, we have control of that. So going back to my old company, once we'd grown enough, we had the resources. We started hiring PhDs directly out of their programs. We've developed a very close relationship with Oxford University. We used to have one full-time and three interns. At the moment, we have one head of research who's been with us for a few years, and we have one intern. And we find that by hiring them directly from STEM and directly out of their PhD programs, that they're unbiased, they're untainted by the theories that they're going to get in a lot of analyst programs, and we believe we now have a significant information advantage over the peer group. And so when we come up with fundamental or even technical ideas, when we construct those trades, we're able to do so with more dynamic information. So a lot of people use end of day prices for recalibrating their models. We look at every price that we can collect through the day. So, for where over one day, the majority of people may look at a simple bid and offer, where we may look at 40 different bids and offers for the same security. And that gives you a different set of sensitivity, a different set of Greeks.
And talking about all this data, obviously once you collect it, you have to do something with it. That's why you have your STEM people. You build models with it, and you've argued in the past that financial models simply provide an estimate based on the subjective inputs that you give it, but that can introduce bias also. So what is your experience with financial models, and why do you prefer to use empirical data if you have the choice to?
Yeah, so as I was discussing previously, I was involved in one of the largest issuers of synthetic CDOs in Europe. So those portfolios were all global. So we had a very large portfolio of credit default swaps of around 500 companies around the world. We had to price a range of different maturities and a range of different tranches. And so not only did I have to trade the credit default swaps, I also had to trade both bespoke and index tranches of
Mhm.
credit default swaps. And you're trading with a range of different banks, all who have different models. And what you find is that not only do they provide you with a bid and offer spread, but they also provide you with a delta. And usually that delta is biased so that the bank can maximize their profit. But it doesn't, it's not consistent. And when you talk to, many of the mathematicians that I did, they absolutely agree that the model was just an estimate, and a lot of the models broke during the financial crisis. So in the case of CDOs, they had to introduce an idea of stochastic defaults. So you went from a world of taking a finger in the wind, or a rule of thumb of saying investment grade companies will provide or deliver a 40% recovery, and high yield companies will deliver a 20% recovery, which is ridiculous. We've seen both ends where we've had zero recoveries and we've had 100% recoveries. Credit default swaps are a very complex product, but these things are very difficult to determine. There's also a lot of conflation of the concept of the majority of companies do not default. So
Mhm.
whether you're trading a bond or a credit default swap, especially over a shorter period, when we're talking about weeks and months, even into years, the majority of companies do not default. So what we're really talking about is spread risk, not default risk. So when people talk about hazard rates as being the foundation of their models, this can be wildly misleading. People also don't think about the volatility of credit spreads the way that they do in the equity market. So, it's very common to measure the realized volatility of a stock price. Then we obviously have the option market, so we can look at the implied volatility from the options and we can compare that with the realized volatility. But we don't have a lot of those same concepts in credit. So the PhDs have multiple different characteristics that we value. They're great programmers. They're used to dealing with huge pools of data. They're totally unbiased. So they don't care whether something is an equity or a bond or a derivative. They can just say, we are going to study the relationship between A and B, and we'll then come back to you and give you facts about how that relationship changes over time.
Mhm.
And what we found is the relationship is often meaningfully different from the thesis, and we can monetize that.
Um, wow, that's really, really interesting. And yeah, I like the parallels you're making about how people think about equities and bonds and how they are fundamentally different, and how a lot of people measure certain things in equities and not so much on bonds. I agree. Now, of course, there's two very different asset classes in nature. One is more volatile than the other. But yeah, no, interesting to hear your comments, and particularly the part where you say that you're not measuring volatility in the usual way, but you're focusing more on the spread volatility. I think that's pretty unique.
Volatility comes in a range of places. I mean, during the LDI crisis, we
Mm,
had huge volatility in AAA CLOs. We had a lot of exposure amongst the UK pension funds. They had a margin call based on their swaps. One of the products the securities that they held in big volume was AAA CLOs. They could sell those, and that led to a very meaningful crisis, for for a range of those pension funds, and even for the UK economy, where the Treasury had to step in. So volatility comes in different pockets, and the negative convexity of credit is part of the challenge. I suppose one of the things that I'd suggest to you and to your investors is that those are often opportunities. When you could buy some of these kind of more beta-like products in credit at a significant discount, then that can be pretty attractive. And whether that's AAA CLOs or triple B CLOs, or we saw the same thing in contingent capital bonds when Credit Suisse defaulted. You have an opportunity to buy the highest quality banks at 30 points below where they'd been trading prior to the default, the sale of Credit Suisse, I should say. So you can turn those weaknesses and that volatility into an opportunity.
I love it. You clearly been also through plenty of very volatile market events, and I would like to get your take, because obviously you've been active in markets, particularly credit markets, since the late 1990s. You've gone through the global financial crisis. You've seen the rise of passive investing, the explosion of private credit now. From your perspective, what are the biggest ways the credit landscape has structurally changed since, let's say, 2008?
So we've seen the demise of credit default swaps, which were very much at the heart of what was going on in the credit markets in 2008. And a lot of people don't differentiate between corporate credit and securitized credit and subprime credit. So the CLO market has grown exponentially. The CDS market and the synthetic CDO market has shrunk significantly. Private credit has expanded rapidly, and that has many buckets to it as well. Everything from a version of leveraged loans to asset-backed lending, to invoice financing and factoring, that can be a really interesting asset class. It's obviously been a relatively controversial one, because some people call things trade finance or invoice financing when it's actually highly concentrated leveraged loans. We've seen the significant progress of the algorithmic and quantitative market makers, particularly in credit. I suppose that's really led by Jane Street, and they're able to take data and algorithms and price the credit ETFs and the underlyings more dynamically than a lot of the banks. And so they've really been able to arbitrage their position as both a market maker and a client to the street, to put themselves in a advantageous position. So there's been more volumes going into ETFs and total return swaps. Markets like the convertible bond market have ebbed and flown. As I said, Europe is still very barren with very little issuance, which is really surprising considering the need for more capital in Europe. But the US market is prospering. There's been a huge amount of issuance, and it's very much open for business for a wide range of issuers. I suppose the volumes and the balance sheet of banks has continued to diminish. So even in what used to be considered relatively liquid, such as areas of the credit market, such as single Bs, have now become less liquid. Well, I suppose we simply try and look at this as the ebbs and flows of the credit market. We know that at Thanksgiving, at Christmas, at New Year's, we are going to see the convertible bond market move down to more like 3 billion, more like 500 million of turnover in a day, where in a normal day, we're getting more like 2.5 to 4 billion of volumes. So we simply kind of accept these facts. The credit market is changing a lot. A lot more of the assets have become private. That means there's a lot of things going on beneath the surface. I make the same point about private credit that I think is valid for private equity, is that the returns are going to be highly dispersed between different managers and different vintages. So there'll be some great results, and there'll also be some disastrous results. And you can see that in things like CLO equity, which is a more public guide, not widely available to people, but it is a good guide. So we're seeing the market go down some very particular avenues in ETFs, in private credit, some things like convertible bonds ebb and flow. Yes, the European market has gone a lot bigger. I don't think it's really become more important. It's still kind of, as a percentage, relatively similar to where it was 10 to 15 years ago.
And what's your take specifically on private credit? I'd love to hear from you. Some people are starting to talk about a possible bubble there that we don't really see because of the lack of mark to market. What's your stance on that asset class? Hey there, quick ad break. Do you work in the finance industry and have a genuinely interesting story to share? I'm always on the hunt for great guests who bring raw, unfiltered insights to the table. Or maybe you know someone with a story worth telling? Please put us in touch. You can reach out to me directly via LinkedIn. I'd love to hear from you. And now, back to the show.
So, I've been in Europe for 21 years now. I've been a part of a CLO management team. In the last decade, I've been involved in a range of complex deals. My wife's a corporate litigator, so I've seen the functioning of the law. So, I've now become a very big believer in US exceptionalism. I don't think that's just measured by the S&P. I don't think that's just measured on the S&P or or kind of defaults and recoveries in distressed credit. I think I think the US market is bigger and better and more robust and more consistent. And the US managers, a lot of the alternative managers that had previously grown precipitously in private equity have grown huge private credit businesses, and some of them are, like Ares, are more dominated by private credit than their private equity business is actually secondary to that. But someone like Blackstone, KKR have both huge private equity businesses and private credit businesses, and they're able to share their resources, their knowledge across those areas. Plus, they have great lawyers. They understand what happens in distress and recovery. They're able to take over a company. They clearly have that experience of what it is to restructure a company and to run it and to then either sell it or re-IPO it at some other point. And it's the same in US middle market CLOs and private credit deals. So, there's a lot more history, a lot more experience, there's a lot more resources, and you've got a much better legal framework in the US. Europe is growing quickly. There's a huge amount of demand, both for private credit, for diversity, which you get in Europe. We need to move a lot of assets off of bank balance sheets. But the European framework is incredibly inconsistent. It isn't robust. It's not predictable. There are very significant biases. So you just have to accept this. So there are real risks in private credit. There is some real marketing spin that goes on. So there's people who talk about their incredibly robust investment process and their modeling, but what we are seeing, what we've experienced, is that there are exceptional managers and there are weaker managers who have more defaults and lower recoveries. And what is concerning and should be at the front of investors' minds is that they do not get publicity about the about the disasters in private credit. They stay very much private.
Mhm.
Even if you are well connected in the credit markets, you'll often not hear about it. There's only certain people who have all of that information, and that's very much a private conversation. It's not talked about in the Wall Street Journal or in the FT. I'd actually think you're more likely to find a YouTube documentary about it than you are in the mainstream media.
Interesting. By the way, what do you read in the morning? FT, Bloomberg, Wall Street Journal, everything?
So I'm moving as far away from the mainstream media. I know a decent amount of the journalists. I talk to them about a range of topics, but I would note that the media are in the business of selling stories. They're not unobjective. They don't. Their mission is to sell the stories to get as many clicks as possible. So, I think a lot of the stories you need to dig deeper, alternative data, looking for different types of researchers. Part of the reason we built the data is so that we weren't reliant on third parties, that we weren't reliant on the investment banks. The investment banks clearly have their own modus operandi and objectives, which is basically short-term and consistent profit, and there's nothing wrong with that. You just have to accept that that's what they're doing. We're trying to make profit from the markets every day, and we need the most objective perspectives, and we also need a range of different sources. So, yeah, things like watching podcasts about electric vehicles. You hear people talking about why even the Porsche Macan is not working. Sorry, Taycan, I should say. That even though this is an incredible piece of engineering, that the price have plummeted, that people don't want to own something with a battery that is deteriorating and that the Chinese are building better and cheaper, and that the technology that goes into a car in Europe or in the US outside of Tesla and Rivian is hugely problematic. And then you've got all the parts providers building their own code. And so you do not have one unified set of code in an electric vehicle the way you do in a BYD or in a Tesla or in a Rivian. So this is why BMW, Mercedes, Volkswagen, and the like are going backwards, and they're just being destroyed by China. When you look at rare earths, you have to really dig in and find out, well, the Western world doesn't, it's not that rare earths are rare, it's just that the Western world does not want people digging them up and having all of the environmental problems. So now we have a real issue where China produces 99% of the rare earths in the world, and we have a trade war and tariffs being implemented. So a lot of companies that are thinking about how are we going to build our 6G technology or drones are saying rare earths are essential for these new technologies, but they're all in China, and we're potentially in a Cold War with China. So what are you going to do? So I just don't think you get that much that much detail and that many of those stories and those ideas from the Wall Street Journal or from the FT. I read them both, but I really skim them now. I find Barron's to be interesting, but it's really independent providers of research looking at data. Things like LinkedIn. All of the incredible people that you've interviewed and thinking about their ideas and where they find opportunities for alpha, for repeatable returns, and then bringing them into your own investment process.
Nice. Yeah, I mean, if you know where to look, there's always like random sources of information that provide a lot of interesting insights. Now, I would like to, as we get closer to the end of the interview, maybe take a step back and talk a bit more about the human side of things. I'd like to hear about the journey of building a hedge fund from scratch, because that's not an easy feat by any standards. And I'd love to hear, first of all, what are the challenges of that you are encountering of being an emerging hedge fund manager?
Yeah. It's basically all challenges. It's a lot like climbing Everest, and probably where you don't have any oxygen tanks, and maybe where you haven't spent the previous year training, and certainly not at high altitude. What I see is, probably two different types of hedge funds that launch, which is people that have been so wildly successful, have enough of their own capital. They say, "I am launching my hedge fund, and you can invest or you can't, or you won't. I'm going to invest my own money using this strategy." And then you see people like Bluecrest and Michael Platt who've turned theirs into a family office and refine the strategy and increase the returns. Then you have the majority of people who have been at the multi-strategy hedge funds. They've run a pod, and then they've spun that pod out, with either seed capital from the multi-strat or from one of the seed providers. And we're doing something that is pretty close to unique and somewhat foolish, in that way that we didn't have a track record. I had a thesis, and I did have a firm, and we'd done advisory, and we'd done some interesting things. But then I had the vision, and then I turned that into a mission to turn that into a hedge fund. I love financial markets. I think the interplay between the world and macro and politics and history and financial markets is incredibly fascinating and interesting. I think there's lots of opportunities. There's a huge amount of room for creativity, but you can also combine creativity with data, um, and you can find, hopefully, opportunities. But people, everybody has their own set of goals and objectives and risks, and people are not really compensated, or it doesn't benefit them on the whole to support a new hedge fund. You have to go out, you have to prove your thesis, you have to show that you can build an investment process, you can build a team, you can build a business, you can build risk management and infrastructure. We decided to partner with Hurricane Capital, who provide us with risk management, with a great trading team, with a marketing team, with an operational team. We share offices with other portfolio managers so that we can learn and benefit from their ideas. So I don't have to do everything, but even that was a lesson, that is harder today. It's harder to get support from the prime brokers and from the capital intro teams, because on the whole, people follow this path. So I decided to do something that was unusual. I didn't realize quite how left field it was when I started. I'm fortunate that I love it. I'm fortunate that my wife has been, and my family have been, very supportive. My family have invested money. Some of my friends have now invested money, and we're slowly, bit by bit, proving our thesis, and proving that we have a differentiated return profile, that we have a differentiated process, that we can scale the business, so that we know how to build the team, we know how to build the infrastructure, and that we will actually be able to build multiple sub strategies, and we'll be able to grow our capacity, hopefully to a significant amount that will be able to bring in a range of different investors. So it is incredibly daunting and challenging. My wife has to be very supportive. It's an amount of stress that is beyond many things. I'm glad I traded through the financial crisis. So when you feel like you're on the edge of the precipice and the whole world is about to collapse, then everything else seems relatively calm. We have a very fortunate life, and we've done many incredible things, and now we're focused on doing something that particularly I'm very passionate about: growing my own business, growing my own team, building the PhD program, working with Oxford University. We've also worked with charities, both at Oxford, but also underprivileged kids at high school, giving lectures to them and
Hmm.
trying to break the glass ceiling into finance and say, we're very big believers in a cognitive diversity. So people that come from different backgrounds and have different ideas, we think that's likely to deliver better results to our investors. We think it's morally right, and it's interesting. So that's the way we've gone about it. But I wouldn't recommend it to too many people. It is incredibly hard. It can be very lonely at times.
Hmm.
But I've been fortunate. I'm getting great support. I now have two senior advisors, both who come from great pedigrees and have a huge amount of experience both in Europe and in the US in convertible and high yield bonds and special situations. I love working with the PhDs. They're incredibly curious. They're humble. Um, they're creative. They're much brighter than I am. And I've learned from Jim Simons, who was a genius, and he says to surround yourself with the brightest people you can, and that's
Hmm.
what I've tried to do.
So, if you had to summarize your main learning from launching your hedge fund about the hedge fund industry, what would it be? That it can be hard and lonely, but also incredibly rewarding.
I don't know about the rewarding side. I find it very intellectually rewarding at this stage. As a business, and ultimately hedge funds are businesses. Everybody talks about performance, but the reality is a hedge fund doesn't survive, doesn't grow unless
Hmm.
you grow the AUM, that you grow the number of investors, that you grow revenue, that you can invest in the business. Thus far, I've used my capital to pay for the development of the business, to build the data lake and the PhD program. But we have very big ambitions. We believe that there is a lot of alpha from the convertible bond market and from convertible arbitrage. We think it's a strategy that is tried and tested. The majority of capital is now run by the multi-strategy funds, so we think they actually congregate around kind of more similar strategies. Our strategy is meaningfully different from theirs. So we think that's an opportunity. But yeah, it is really hard. Um, it's hard to find the right advice and mentors because the market's moved on a lot. So if you weren't at one of those multi-strat firms and the prime broker doesn't take you under their wing and say, we will find the right regulatory host, the right administrator, the depository, the risk management system, what you're going to do with trading, operations, finance, the whole thing.
Hmm.
It is hard to get those lessons. It's hard. I've had to really build a community. So, I now have really close relationships with a lot of peers, a lot of other hedge funds where people say, okay, you need a new IT provider. If you really want an admin, um, to, who supports a hedge fund and understands your challenges, then you really should look at these people rather than others. Same with prime brokers. Every prime broker is different, so you really need to find the right partner. But that takes skill and experience and insight. So, fortunately, we have a lot more of that today.
Hmm.
But it is very hard. So, I think you've got to understand the probability of success. You've got to understand what it takes. If we do not provide consistent returns, high risk adjusted returns, consistent alpha, transparency, differentiation. In our case, we want to be very low correlation to traditional markets. We want to have a higher hit rate than most. And we want to demonstrate to people how it's both scalable and repeatable. Those are going to be the things that ultimately drive our success. Um, but it's got many challenges, but it is rewarding in many different ways.
Hmm.
It can't just be about rewarding for the money.
Well, I'm excited to see where this journey brings you. I'm pretty sure you're gonna do a great job, but markets are not easy. So best of luck with that. And before we wrap up the conversation, I have a last question that I always like to ask my guests. What would your advice be for listeners, particularly young listeners that are thinking about working in the finance industry and specifically joining a hedge fund manager?
So I would say the thing that's helped me the most, in particularly as I've gone deeper into my career, is reading the books and the white papers, the research papers of the market leaders. So there is now a treasure trove of information. It's almost daily on LinkedIn and people who publish, but there are incredibly informative books that I think are better than most university programs. So I would definitely, there's great value in and especially in the good university programs. That said, part of my international experience has been, when you look at the great finance programs and you have industry leaders giving lectures, that's very different to people who are purely theoretical. So now
Mhm.
you can watch those lectures on YouTube or on websites. So going to Yale and Harvard Business School and Columbia and Wharton, there are the books, in my case, reading about Jim Simons or Edward O'Thorpe, you know, uh, reading Hedge Fund Wizards, and learning about, how Mike Platt thinks about risk or how Jamie Meyer thinks about options. Um, you know, I'm reading incessantly, and I suppose the more personal advice would be to say to get great mentors, build relationships. You know, empathy and building relationships was always important, but it's becoming even more important. But having mentors and people who can guide you, not
Mhm.
having to make all of the mistakes yourself, not having to learn all of those lessons, I think is hugely valuable. And I certainly wish I would have done that earlier in my career.
I love it. Read and network. You heard it. Wise words from Orlando. Orlando, it's been an absolute pleasure to have you on the show. Thank you so much for sharing all those gold nuggets, insights of information. I'm sure our listeners found them very, very useful. Very excited to see where your convertible arbitrage strategy brings you. For sure, one thing I'm going to do after this call is dig a little bit more into convertibles because it's a part of the market that I don't know enough about, even though I find it very, very interesting. And best of luck for the rest of the year. And let's keep in touch. And for our listeners, by the way, make sure you follow Orlando on LinkedIn. He publishes very, very regularly incredibly interesting insights. And make sure to check the website, Farrier, where you can find more information about his strategy. Orlando, thank you so much for joining.
Ignacio, thank you very much for having me here today, and great to share this conversation with you.
The Blunt Dollar is written, produced, hosted, and edited by me, Ignacio Ramirez. Everything you hear, concept, script, sound design, and production comes straight from my desk, and occasionally my kitchen table. Thank you so much for listening, and join me in the next episode of The Blunt Dollar for more raw, honest finance conversations.